Hello everyone, welcome to our YouTube channel Finbuzz Learning. Here we are again back with the new topic of finance, which is financial asset management companies. So, we will discuss everything about financial asset management companies in detail. So, first we will understand what asset management is. Asset management is the process of managing the client asset with the target to increase the value of the asset. This can be achieved by planning, acquiring, deploying, managing, and disposing of the client's assets. The term is frequently used in the financial industry to refer to individuals and businesses that manage investments on behalf of other people. These include, for instance, investment managers who look after a pension fund's assets. In order to ensure a coordinated approach to the optimization of cost, risk, service, or performance and sustainability, it is also increasingly used in both the commercial world, public infrastructure sectors. Now, we will understand what financial asset management company is. So, a company known as financial asset management company invests a pooled fund of resources on behalf of its clients. Different investments in a range of asset classes are financed with the funds. The term asset managers and asset management firms are also frequently used to refer to asset management corporation. So let's understand about the asset managers who are the key players in the asset management company. The asset manager is responsible for creating the client's portfolio, overseeing it from day to day, making changes to it as needed, and communicating regularly with the client about those changes. Now, coming to the types of products offered by the asset management companies. So, there are various types of financial assets. We will discuss them in brief. The first type financial asset, which is the asset management company offers, is cash and cash equivalents. It is the financial asset that are short term, quickly convertible into cash, and have greater credit quality are known as cash and cash equivalents. These assets include cash, checks, money in bank accounts, and investment securities. Highly liquid assets that produce income in the short term are cash equivalents. Highly liquid assets include US Treasury bills, top notch commercial paper, marketable securities, money market funds, and short term corporate bonds. The next type is accounts receivable. So, accounts receivable is the term used to describe the amount that will be received from customers after a bad debt adjustment. If the payment is not made within the credit dates, interest is additionally charged. Fixed deposits are also the type of asset which is a financial company offers. In this, the interest and principal payments are made to the depositor on the maturity date using a fixed deposit facility. Example, a depositor deposits $1 lakh with a bank for a year at 8% simple interest. On the date of maturity, the depositor will receive $1 lakh plus $8,000 in interest. Another type is the equity share. The amount that the company's owner have put into their enterprise is known as shareholders' equity. This includes the funds they have personally invested as well as the total amount of earnings that have been reinvested by the business since its beginning. Next type of financial asset is debentures and bonds. This is a sort of financial asset known as debentures or bonds is one that a corporation issues that gives the holders the right to monthly interest payments on a defined date and the repayment of the principal upon maturity. In contrast to dividends on equity shares, interest payments on debentures must be made on even if the business experiences a loss. These holders are given preference over equity and preference shareholders upon liquidation. Now we have another type which is preference shares. So, preference shareholders are the owners of preference shares, which have no voting rights but grant the holders the right to dividends. These investors, like those of debentures, are paid a predetermined dividend rate, whether the company makes money or loses money. Preference shareholders in liquidation have a claim on asset before equity shareholders, but after debenture and bondholders. Mutual funds are also the type of financial asset. So, mutual funds assemble capital from small investors and place it in a variety of financial markets, including the debt, stock, and commodity markets. In return for their investment, mutual fund investors receive units that can be purchased and sold on the open market based on market prices. The capital gain and any income received on the initial investment amount are simply added together to form the return on investment. The unit holder would suffer a loss if the fair value of the units dropped at the same time. Now, the next type is interest in subsidiaries, associates, and joint ventures. So, the subsidiary is a business that has another business, the parent firm, controlling more than 50% of its stock. A parent firm will combine its own operations, financials, including those of its subsidiaries, and include them in its own consolidated financial statements. A subsidiary pays dividends and shares of profit to the parent. A joint venture is an agreement in which the parties share control of the arrangement's net assets. A company that one investor has 20% or more of the voting power over is referred to as an affiliate, significant influence. In contrast to a subsidiary, the investor company reports the associate company's value as an investment on its balance sheet rather than consolidating its financials. The associate joint ventures portion of profits is split and reported in the investor book. So the next type of financial asset are insurance contracts. According to IFRS 17, insurance contracts are agreements whereby one party accepts a sizable insurance risk and promises to make restitution to the other in the event that a specific uncertain future event, which is also an insured event, negatively impact the policy holder. As a result, the risk that the policy covers determine the contract's value. When life insurance plans mature, they pay the maturity value of the policy to the insurance holder and become financial assets. Rights and obligations under the lease is also the type of financial asset. So, a lease is a legal agreement that stipulates how long one party will permit another party to use a piece of property in exchange for regular payments, as they produce an asset for the business in exchange for the assets being used by another party. Such receivables are financial assets. Share-based payments are also the product which is offered by the asset management companies. So the share-based payment agreements are contracts between two parties that gives the recipient the right to receive cash based on the value of the entity's equity instruments such as shares and stock options. For example, a company buys certain assets in exchange for its own stock instrument. Derivatives are also known as the popular financial asset offered by the asset management companies. Contracts known as derivatives, which are used for hedging, speculating, arbitrage possibilities, etc., derive their value from the underlying assets. Contrary to debt instruments, however, such a contract does not generate principal or investment income. Swaps, options, and futures contracts are examples of common derivatives. Now, the last type of asset is employee benefit plan. So, a defined benefit plan is a post-employment benefit plan as defined by IAS 19, where an entity estimates the total cost to the entity for the benefits that employees have occurred as compensation for their service in the current and prior periods using actuarial methods, which is the projected unit credit method, and the method of projected unit credits. The approach also subtracts the fair value of plan asset from defined benefit obligations, calculates the shortfall or surplus, and in the end determines the amount to be recorded in profit and loss and other comprehensive income. Well, this was all about different type of financial asset management product. Now we will understand the different advantages of asset management. The first advantage is economies of scale. Economies of scale are the cost advantages a business can obtain by expanding its operational footprint. The operational cost per unit are lower in larger businesses. Asset management firms, for instance, can buy securities in greater amount and bargain for more favorable trading commission rate. Additionally, they can put a lot of money into a single office, which lowers overhead expenses. Access to broad asset classes is also the benefit in asset management companies. Asset management firms have access to a wide range of asset classes, allowing them to invest in asset classes that an individual investor would not be able to. An AMC, for instance, might finance multi-billion-dollar infrastructure initiatives like a power plant or a bridges. Due to the size of the investments, an individual investor typically cannot access them. The last advantage is the specialized expertise. So, asset management firms that hire finance specialists with substantial experience managing investments, an experience that the majority of private investors lack, are said to have specialized competence. As an illustration, an AMC may employ a variety of experts in particular asset classes, such as real estate, fixed income, sector specific shares, etc. Now, asset management has different disadvantages which we will discuss here, starting with the first disadvantage, which is management fees. The majority of asset managers impose fixed fees that are paid regardless of results. As a result, over time, investors may find the fees to be very costly. The fees are substantial to cover these costs and to give asset managers a profit as well, because running an AMC requires a lot of resources and experience. Another disadvantage is inflexibility. The asset managers have the potential to grow too big, becoming unwieldy and unresponsive to the changing market. Operating issues can occasionally result from managing too much capital. Risk of underperforming can also be the disadvantage here. A benchmark is frequently used to compare an AMC's asset management company's performance. In order to compare performance, a benchmark is used, typically in the form of wide market index. Asset managers run the danger of underperforming the markets, which can be highly expensive for investors, which you factor in the management cost we previously stated. So in this video, we have learned about asset management companies, different type of asset management products and their advantages and disadvantages. Thanks for watching our video. Do subscribe, share and comment. We will discuss the different topics of financial asset which is offered by asset management companies in detail in our upcoming video.